Hello everyone. So in this chapter 19 we are going to discuss exchange traded funds. Now this topic always belonged with other subjects in CSC, but few years back they separated and made it an independent topic. Now this is extremely important because exchange traded funds are getting more and more famous in Canada, and it has become a go-to product for financial advisors. So you can be texted extensively on this topic, and also when you start advise on your own, this topic is important. So what are we going to discuss in this chapter? So in this chapter we are going to discuss the regulation and structure of exchange traded funds, key features of exchange traded funds, the various types of exchange traded funds, the risk of investing in ETFs versus mutual funds, comparing exchange traded funds and mutual funds, taxation of investors, and other related products. So these are key regulations that you should be aware of. So regulations are NI 81-102, which relates to all ETFs structured as open-ended mutual funds. So 81-102 is common between mutual funds and ETF. So it generally talks about all open-ended funds that are there. So it includes ETF as well as mutual funds. 81-104 is specifically related to ETFs that use derivatives. So ETFs that use commodities or derivatives, either one of them or both, then 81-104 will be applicable. National Instrument 31-103 means gives registration requirement, exemption, and ongoing obligation. And National Instrument 41-101 gives client disclosure documents. So ETF fund facts is a document that is required when you sell ETF. It is similar to mutual fund fact. So this document is regulated, or the specifics of this document is given by National Instrument 41-101. So what is ETF fund fact? It is similar to mutual fund facts like we have discussed in the last module, but there are certain additional things. So additional information regarding trading and pricing characteristics like market price, bid-ask spread, and discounts to net asset value is also there. So apart from all the things that are covered in a mutual fund document, it also covers market price, bid-ask spread, and discount to net asset values. Now there is also one significant change between ETF and a mutual fund document. A mutual fund document has to be given before the sale is made. An ETF fund fact is to be delivered by a dealer within 2 business days of purchase. The difference is because ETFs are bought on exchanges. So an investor goes and buys an ETF on an exchange. So you don't have to give a ETF fund fact before the purchase is made. You have to give it within 2 business days of a purchase. Now if an investor doesn't get that fund fact document, he may deny that purchase. So he may rescind that purchase. Now this is structure of ETF and creation and redemption process. So there is an ETF company, designated broker, stock exchange, then there is seller and buyer. Now how does it work? So ETF company creates certain shares, creates certain units. So it gives prescribed number of ETF units to a designated broker, right? And the designated broker gives basket of securities back to the ETF company. So for example, let's say we have decided that 10,000 units initially, mutual fund units, correspond to 500,000 shares of S&P 500 company, right? So whatever S&P 500 index is there, or let's say TSX 60. So there are 60 companies in TSX. So we want 500,000 shares in the proportion that 500,000 amount of a dollar value of shares in the proportion that TSX 60 has to correspond to 50,000 shares. So what will happen? The ETF company will generate 50,000 units. The designated brokers will go out in the market and either buy from the stock exchange those shares, or they will they will borrow those shares from the exchange. So either they buy or they borrow. So they have $500,000 worth of shares. ETF has $50,000 worth of units, and then they exchange. This is called as in-kind exchange. Okay, so ETF units are given to designated brokers and basket of stocks are given to ETF. Now these ETF shares are then sold by designated brokers on an exchange where buyer and sellers buy them. Okay. Now one important factor that the book covers, there is a continuous exchange also. For example, ETF units and the corresponding shares should trade at similar values. So values of ETF units should correspond to the share values, the underlying values that they are based on. If the share price, the unit price of ETF goes way beyond what those shares have, so cumulatively they have value of 500,000, but the value of ETF units becomes 600,000. So what will happen? The designated broker can make money out of it. How? He will procure those shares from the exchange, right? Exchange them with ETF and get units and sell those units. So he can do an arbitrage trade. So if the value is low, the designated broker does arbitrage by buying the shares, exchanging it for unit and selling those units on an exchange. If the value of shares is high, the other thing happens. He acquires those units, go to ETF company, get those shares back and sell on an exchange. So there is a continuous arbitrage done by a designated broker with an ETF company. That's the reason the unit price and the share price trades similar. The feature of exchange traded funds, low cost. The cost of exchange traded funds is generally low. So it is low because the management expense ratio is generally low. Most of them are passive, so MER reflects that. Another fact is there is no trailing commission. So if you go into a mutual fund, there can be front end, back end, as well as continuous commissions that you have to pay. In mutual funds, you just pay commissions when you buy and sell. You don't pay, generally mutual funds, generally ETFs, in ETFs you pay commissions only when you buy and sell. ETFs do not have commissions on a regular basis, so there is no trailing commissions. Next, tradability, liquidity and continuous price discovery is there. So ETFs can be traded on an exchange, so it improves the tradability. Liquidity depends on what the underlying asset is. So if ETF is based on something as liquid as TSX 60 or S&P 500, then it is liquid. But if it is based on small cap international stocks that have low liquidity, the liquidity is low. Also, there is continuous price discovery, and this is important for illiquid assets. So continuous price discovery means that even though the ETF is based on some international stock and the international market is closed, still the price of ETF will continuously reflect those news and they will match up when the market opens there. So that's the benefit. To give you an example, let's say you are trading on Chinese stocks, right? And you're trading on a Chinese index in Canada. So when Canadian markets are open, Chinese markets are closed. But any news that reflects China, any news that pertains to China will have an impact on the ETF price. So there is continuous price discovery even when the markets are closed. Then they generally have a low tracking error. Now what is tracking error? Tracking error is difference between the actual return the ETF has given minus the actual return that the index is given. So if index is giving 10% and ETF is giving 9%, the difference 1% is the tracking error. Tracking error is generally negative, but it can be positive also. Then there is tax efficiency. So they generally are passive investments that don't buy and sell stock much, so that's the reason the turnover is low. Also, in-kind exchange, that is, most of the times there is no capital gains because there is in-kind exchange between a designated broker and the ETF company, so that doesn't generate any tax. They are very transparent. In US, an ETF has to disclose its unit every day. In Canada, the rule is that they should disclose them quarterly, but still most of the ETFs even in Canada disclose it every day. Then there is low cost diversification. So cost is low and you can get into a lot of stocks by putting in small amount of money. And there is target exposure, so you can get target exposure without investing huge sums of money. And specifically, you can get into trading strategies that are difficult for individual investors. Next, types of ETFs. So there is standard index based ETF which has full replication, so they replicate the index in totality. So whatever stocks in whatever proportion that are based in index, they will buy that. Second, sampling, generally used with fixed income, because fixed income indexes may have 10,000 bonds in them. Now it is very difficult to go out and buy those 10,000 bonds. So what does the fund manager do? They pick and choose the bonds that overall represent the index and they buy only a sample. Then there is rule-based exchange traded funds. Rule-based exchange traded funds trade with certain rules. So for example, in S&P 500, my ETF doesn't buy all 500 companies. It buys only companies that have above average earnings and low valuations and high dividend yield. So for example, this is my rule. So all companies that qualify within the subset for those rules, I buy it. So this is an example of rule-based exchange traded fund. Next is active exchange traded funds. So they are not passive, they are more like mutual funds where they try to pick stocks and try to get ahead of the market. Synthetic exchange traded funds, they use derivatives but they don't take leverage. So they invest in a particular asset by taking derivative, but there is no leverage into it. They only invest 100% of their fund value. Leverage exchange traded funds, these exchange traded funds take leverage. Leverage means the returns are amplified. Example will be a $2 return for every $1 move in the index. So if the index goes up 10%, you get 20%. If index goes down 5%, you lose 10%. Inverse ETFs, they take inverse positions in index. So if index goes up, you lose money. If index goes down, you make money. That is an inverse ETF. Generally, they go short on specific indexes. Commodity ETFs, they invest in commodities either based in physical form, future based or equity based. Physical based means they buy physical commodities. Future based means they get into commodities by investing in futures. And equity based means they buy companies that are in the supply chain of that commodity. Means they are either a mining company or they are a distribution company, the company that has bearing on those mining, on that commodity. Now generally with future based ETFs, they generally have a rollover loss. So what is rollover loss? So future products are there only for a specific time period, let's say 3 months. Now every 3 months you have to sell the current future and buy the next one. Now most of the markets are in Contango. So there is Contango and Backwardation. Contango means the future that you are going to buy will have a higher price than future you are going to sell. So next month's future will have a higher price than current month's future. That is Contango. Backwardation is next month future has a lower price than current month future. Now most markets are in Contango. Because of that, when you roll over, when you sell the current month future and buy the next month's future, because the price of next month's future is high than the current one, you have a rollover loss. Then there is also covered ETF. So covered ETF means you buy the stock and then you sell a call option on that index. For example, if you are doing a covered ETF strategy on TSX 60, you buy all stocks that are there in TSX 60. Step number 1. Step number 2, generally you sell at the money or out of the money call options on TSF 60. Now when you sell call options, you get premium. So it is kind of a rental strategy. You already have a stock and you sell the call option to get rent or get premium. Now what happens if the market stays same or it goes down, you pocket that premium. But if the call is assigned, if it reaches that price and the call is assigned, then you sell those stocks to deliver your money. Now while choosing covered call ETF, you have to look at management constraints. So if any management constraint is they have, then there is fixed or variable payments. Fixed payments may erode your principal, because if the premium is not enough, then the manager would have to sell the stock to give you payments. Variable payments doesn't erode principal, but then the payments would be variable. And also check the fees, but generally fees are quite compatible as compared to doing the covered call option on your own. Now risk of investing in ETF, then there is risk related to tracking error. Tracking error is a result of fee and expense. So fees and expense generally lead to tracking error. Then there is sampling method. So sampling method means instead of buying the entire index, you're taking a sample out of it. So since you're sampling it, there would be some error that results due to sampling. Liquidity. So sometimes it is very difficult to buy and sell the stock actually. So it is very easy to do it hypothetically, but to do it in actual practice it's difficult. So liquidity may be a concern. Cash drag may be a concern. All cash may not be invested by the ETF, so that cash drags the returns. Rebalancing, again hypothetically it's very easy to rebalance a particular index, but to do it in practice is much more difficult. Then currency hedging. Most of the ETFs that invest in international markets also take short position on a particular index. For example, if a Canadian ETF is investing in emerging markets, let's say in India, then it takes a short position on Indian rupees. The reason why it does it is to mitigate losses due to currency movement. Now because of those things, it has to pay cost for doing that. It has to pay cost, it has to pay commissions for doing that currency hedge. So that currency hedge may lead to tracking error. Then concentration risk. Concentration risk means if you're not buying a broad index in an ETF, if you're buying a concentrated index that let's say composes only 20 stocks, then you have a concentration risk. If your investments are not diversified enough, then you have unsystematic risk that is present in your portfolio. That is nothing but concentration risk in terms of ETF. Then there is risk related to the composition of ETF. So composition can be physical based or derivative based. If it is derivative based and if swaps are used to construct an ETF, then it becomes a problem, because when swaps are used in derivatives, then swaps has counterparty risk, so that creates a problem. Now security lending, most of the ETFs have shares that they lend to market for trading, right? This is an additional way of generating some money. So that money, that amount that you generate by lending those shares, right, is generally additional income for ETF. But the person who is borrowing shares from you may not return those shares to you. That is a counterparty risk that the ETF face. Now, comparison between ETFs and mutual funds. Management style of ETFs is mostly passive. MF, mutual funds, it's mostly active. Transparency is full because ETF disclose their units every day. Mutual funds is limited. They generally disclose it quarterly and they only highlight top 10 holdings. Cash drag is low. Cash drag is high in mutual funds because mutual funds have to maintain higher cash for redemption purposes. Embedded fees are low. Embedded fees are high. Advisory compensation is commission when you buy and sell ETFs. It is fees and load, and it has a large trailing component. Distribution is like stocks, so they are bought and sold on an exchange. Mutual fund, it is primary market, so you directly buy from the source, that is the mutual fund company. Tradability, margin and short sold, they can be used as a margin to borrow money. They can be short sold. You can put limit and stop loss trades. Mutual funds, short selling is not allowed. You can use them for margin, but limit and stop loss trades are not relevant because it's a primary market transaction. Minimum investment in single units, it's $500 or maybe lower than that also if it is systematic investment. Now, you can have pre-authorized contributions or systematic withdrawal plans. Easier on mutual funds, they are way harder on ETFs. Dividend reinvestments, only few dividends are reinvested. Few ETFs allow dividend reinvesting. Most of them pay dividends as cash. Mutual funds, they generally allow dividend reinvesting. Liquidity, it is based on underlying. It is based on generally mutual funds, you buy and sell at closing NAV. Tax efficiency is more in ETF because they are more passive, less in mutual funds because they are active. Tracking error is less in ETF and it is more in mutual funds. Now, taxation of ETFs. Taxations is based on distributions that the fund makes or purchase and sale of ETF. So quickly, when you buy and sell ETF, either you can make a capital gain that you have to pay tax on, 50% of it is taxed, or you make a capital loss. Capital loss can offset capital gains in last 3 years. It can offset capital gains in current year, or you can carry it forward for future offsetting indefinitely. Now, distributions, if it is dividend and interest distribution, it will be taxed accordingly. Interest is taxed according to marginal rate. Dividend is taxed, but you get some dividend tax credit if it is a Canadian company. Capital gain distribution. So there are two important things that you have to remember: capital gain refund mechanism and reinvestment phantom distributions. So it means that capital gain refund mechanism means when you have already paid some tax. So it generally happens when reinvestments is there. So when reinvestments is there, you have already paid some tax on the distributions you have received. So because of that, your adjusted cost basis, your cost basis is adjusted to reflect that. So if you have got $100 of distribution, which is again reinvested, then that $100 increases the adjusted cost basis. So this is covered in both of this: capital gain refund mechanism and reinvestment phantom distributions. Next, there is non-cash distributions, that is return on capital. Generally results because of non-trading activities like renting out shares. It's an example of non-taxable contribution. So rent that you receive, generally you can structure it as ROC, return on capital. So you are not explicitly taxed on it. Okay, so distributions are taxed like this. Dividend and interest. Dividend is taxed, but you get dividend tax credit. Interest is taxed at marginal rate. Capital gains are taxed at 50%. right? But you get refund mechanism as well as reinvestment phantom distributions based on reinvestment. So adjusted cost basis changes, and non-taxable distributions, that is return on capital. Now tips for trading: always use limit orders when you're trading in ETFs. Place large trades, so do not place small trades, because then it gives the designated dealer some space to generate those units. Avoid beginning 15 minutes and end 15 minutes while you're trading, because the volatility of market is extremely high during that time. Avoid trading when underlying securities are closed, because then the price discovery mechanism and arbitrage doesn't work, so the ETFs can deviate in value. Avoid trading when underlying securities trading is halted because of news or certain corporate disclosures. So more complex exchange traded fund roles. So you can have core and satellite portfolio construction. Core means there are certain ETF products that you keep in core, and satellite portfolio means you take advantage of the market by putting some money in other ETF products. ETFs can be used for rebalancing, so it is very easy to do it in ETF. Let's say you want to change your allocation from equity to debt, so you can start buying debt ETFs rather than buying bonds, which is difficult. You can do tactical asset allocation. Moving between funds is much easier. Cash management is much easier in ETFs because they have lesser cash drag. Exposure to one's hard to access market is there, because you have you can buy emerging markets ETF and international ETFs. Also ETFs can be used for tax loss harvesting, that is selling at a loss at the end of the year to get certain tax breaks. That can be done by ETFs. Other related products in ETFs are mutual funds of ETFs. So these are mutual funds that invest in ETFs. Then there are exchange traded notes. Exchange traded notes are generally guarantees that are given by banks. So these are not generated by the fund houses, these are generated by banks, and bank guarantees to pay you based on the index performance. So you invest $100 with bank, and based on the index performance the bank will pay you interest. So these are called as exchange traded notes. They are quite different than ETFs because they also have counterparty risk. If the bank defaults, then the notes default.